here we go. So, and as kind of I mentioned, my name's Jake with JCCS here and one of the tax partners. There's my email, I'll have that at the end, so you can reach out to me if you have any questions or further clarifications needed. This is just, of course, our disclaimer. We're recording this. Make sure that maybe don't take everything that I say exactly as it will apply to you. Everyone's tax situation is different, so make sure you seek me or your tax professional to make sure we got the right answer. Okay, and so as you probably are aware while you joined and you're kind of hoping to learn, this is just kind of some items that I'm hoping that you walk away with knowing as much as you possibly want to or could know about the items. We're going to go over all the entity types that for those that set up businesses, maybe even have businesses currently set up and running, just understanding what your options are, knowing the pros and cons in general, what each of those are. And then one of the S Corp is that buzzword that we hear a lot about. A lot of clients ask me about that. So we're going to go over those, the rules surrounding that. And then getting into the weeds a little bit, I'll just touch on those because it's kind of, it's very complementary to talking about S corporations specifically. And that's just talking about reasonable compensation. And then also kind of globally for all business types, understanding, very quickly understanding the new QBI rules, qualified business income, and the deductions around that. So that's a quick overview. I'd like to lay down some ground rules as well. I am a CPA. I am not an attorney. So everything I talk about today will likely be from the tax perspective. I will glance over at the legality of some things. However, I know just enough about that stuff to be dangerous. So, and I'll mention that a lot too. And when we're setting up some sort of a business entity, it's always great to get the attorney involved, make sure what we are doing satisfies the legal gods. I take care of the tax world, but we need to have that other professional help us out in the legal field. And then also, it's really important to know that I've got a Montana bias, obviously being a CPA in Montana. So a lot of what I will talk about is kind of from the Montana tax perspective. However, we need to be very mindful of how each state has their own rules, especially when it comes to setting up a business. Where's the business set up? Where's the property? Where are the employees? We need to be very mindful of each of the individual state rules. They're all different. And so in general, we'll talk about the federal rule here today, and then kind of Montana is usually pretty good about following the federal rules, but just know that we've got to be mindful if we are dealing with other states. Those are the ground rules. I think we can play by those rules. Okay, entity types. These are the 5 most common entity types that we likely and do see. Now, there are more, but if I had to say what is 99.9% of most businesses that I work with, here is the list. So you have your sole proprietorships, partnerships, 2 different types of corporations, your C Corps and your S Corps, and then you have the LLC, limited liability company. And so we're going to go into each one of these, and we're going to talk about the pros and cons of each, and we'll do some comparative, just kind of overlap on each one of these and get to know each one of these a little bit more personal. So let's talk about sole proprietorships. The most basic entity structure. And that's obviously leading off in the pros list here. Oh, quick comment, pros and cons. A pro could actually be a con to some, and a con could be a pro. So it's really important. This is, and I'll make this point as I walk through these, but just kind of know that I tried to put them in a bucket, but it's not necessarily it's a terrible thing if it's a con or it's the best thing ever because it's a pro. It's almost a pro and con as compared to other entity structures like a partnership and a corporation or an LLC. So I'll make that distinction, but bear with me that I attempted to make buckets here, but it's not a hardcore pro or con. So easy to start up. What I mean by that is a sole proprietorship is as easy as just as walking out and holding yourself out as a business. There's no formal setup. There's no formal meetings. There's no bylaws you have to write up. if I wanted to go out to the street and sell Kool-Aid, I could do that. And I've essentially started a sole proprietorship. I don't need to register with anybody. It's just, that's my business model. And so while it's easy to start up, there's no formalities or whatnot. The cons, of course, are that there are no, and this is here I am jumping into kind of the legal world. And so there is no personal liability protection. Okay, now as the tax person, I'm going to stop. Seek your attorney for what does that mean, but essentially, in general, there is legal liability protection in these entities that we're going to talk about today. The sole proprietorship does not offer that. You as a sole proprietor are extending yourself out into the business world, but as the individual. So for example, if I have that Kool-Aid stand and I spike that Kool-Aid with something that I probably shouldn't be putting in it, I'm now liable for the person paying me for that product, and then they can come after me personally. And so, as opposed to maybe a different entity structure where they couldn't come after Jake, they would come after the business, my business. And so that's really, when we talk about liability protection, that there is at the core of that understanding, is that in a sole proprietorship, there's none of that protection. So there is no boundary there between the human Jake and Jake's business in this setting. And then again, here's another great example. So I put subject to self-employment tax. That's not a terrible thing, but commonly people don't tend to love to pay tax. And so a con in this case is that all of your income stemming from this business will be subjected to self-employment tax with some limitations. But for purposes of this discussion, it's more or less a con in the sense that all of your income could be subjected to self-employment tax. There are other entities where we could maybe get around that. So now let's jump into the next one. So that was a sole proprietorship. The next one on the list was a partnership. The pros here, and I put 2 or more people. So as soon as you bring in a second person or more than 2 people, you have to essentially you have to have more than just a sole proprietor, sole meaning one. So now a partnership, you form 2 people. So a pro there just be that you're bringing in more brain power essentially. So the partnership gives way to that ability. And then a true partnership by definition, technically, is one that doesn't necessarily need to be registered with the state. That's the true definition. But I highly suggest that you do register. It will behoove you to not only register, but also another requirement is not necessarily to have partnership documents, and I highly advise against that because years down the road you're going to need to point at something that says this is the rule. Jake owns 50%, Jake's partner owns 50%, or what are the rules? There needs to be kind of rules of engagement. A true partnership per se doesn't need that, but I highly recommend it, as well as registering with the state or looking into registering with the state. And then the cons, as opposed to the simplicity of, let's say, a sole proprietorship, even though if there is more than 2 people, we can't be a sole proprietorship. But the con here is that when you form a partnership, you now have an additional tax return to be filed. So there is some more compliance involved. Instead of just all going on your personal return, there's now a partnership Form 1065 we got to file. So not the end of the world, but just something to be mindful of. And then this is kind of going into the legal area again. So each partner could be personally liable depending on the choice of partnership. Something we haven't really talked about yet is that there's actually multiple types of partnerships. There's general partnerships, limited partnerships, limited liability partnerships. There's actually limited liability, limited partnerships. So, I mean, there's actually more than just a partnership. In fact, once you're a partnership, you kind of have to choose which kind you're going to be. In general, I see limited partnerships. These are very common in the family business world. And so going back to each partner could be personally liable. A lot of these, like a limited partnership, it's trying to segregate who truly is personally liable. And so there might be a general partner that takes the burden of the liability, where the limited partner is behind the scene. So again, very common in family structures. Maybe mom is the general partner, and then the sons and daughters are all the limited partners. Common, but again, depends on what the business is, what's going on to truly say, let's start a partnership, but that's just where we oftentimes see it. A con where there's a potential loss of autonomy. So again, there's more than one person here. So it's really, that statement is who's the boss. In a partnership, you'll have a document that states maybe ownership percentages, but everyone's a member, everyone's a partner. And so there isn't necessarily, and there could be, there's tax matters partners and there's representatives of the partnership, which should be outlined, but you can get into a case where there's no autonomy. If it's 33, 33, 33, who is making the final decision? Who's the tiebreaker? So that's a potential issue there. And then again, subject to self-employment tax, that's kind of sort of sometimes maybe. There's ways to structure it to where one partner might be exposed to self-employment tax and the other one's not. Sometimes, like in general partnerships, they're all subjected to self-employment tax. So it's very important that if you go down the partnership route, that you've kind of get your ducks in a row, what kind you want, and then just being very clear on one of the pitfalls could be that maybe will everyone be exposed to self-employment tax? Maybe we shouldn't be a general partnership. Maybe it should be a limited partnership. So a couple of the items there. So that's the partnership rules. The next item, I'll get into the corporate world now. So the first one are the C corporations. Some of the pros, C corporations, it's an independent entity. So now we are officially drawing the line in the sand. There could be owners of the corporation, but they're off on their own. They just happen to be part of this corporation, and the entity itself is this legal owned entity. So there really is a division between the business and the people behind the business. And so separate from owners. And then autonomy, where the partnership might not have had that, the corporation structure, the corporate structure really does. There is autonomy. There will be, usually when you write your bylaws and you have your articles of incorporation, it'll be lined out. Who is the president, vice president, who is the CEO, who is the CFO. A lot more structure. A lot more structure. In fact, that's one of the, I guess you would deem cons, is that they're very complex. You need to have minutes. You need to be very structured, and that's to maintain that status of legal independence, separate from the owners. Back to some of the pros from a tax perspective. You can look at deducting certain fringe benefits. We can sometimes more or less get those in other entity structures, but that's one of the ones that kind of stands out oftentimes for the C corporation, is that you can get away with maybe some more aggressive fringe benefit deductions. And then a potential pro right now too, sort of, it can be a flat income tax rate. Obviously everyone's tax situation is different, but the flat rate right now is 21%. That could be maybe looked at increasing one day, potentially decreasing, maybe not. 21 is pretty low in the history of corporate tax. So while 21% and a flat tax rate sounds great, don't forget that one of the biggest cons, and I would say probably the number one con with a C corporation, is the idea of double taxation, right? In order to get money out of a C corporation, it's kind of one of two ways. You have to somehow run it through wages, or you have to issue, it would be a taxable dividend getting money out. And so not only would the bottom line dollar for that year get taxed, and so whatever didn't get ran through wages, in order to get the remainder of that money out to its shareholders or its owners, it's through a dividend. So there's yet another level of taxation. So you can have a 21% tax on top of that, 15% on top of again. So really something to be very mindful of in the C corporation world. They're not as common quite as much anymore. And that's really because we've come to learn and to know about the S corporation. And so the S corporation really has almost all the same characteristics, almost all, as the C corporation, except the big kicker is that it's getting around the double taxation piece. And so essentially that bottom line dollar, it's not taxed, rather it's taxed at the individual level, but then that's it. And so it's a flow through, it's a pass through entity. So meaning that bottom dollar doesn't get assessed a tax like the C corporation, rather it flows through to each of the owners of this S corporation and then tax at their personal rates, and then that's it. And now they can take that money, and whether they drew that money out or not, that's to be determined. But then once they pay their individual tax rate on that, now they can draw that money out whenever they want, and it's not double tax. So that's like one of the biggest benefits of having an S corporation. Now, a true S corporation, and I'll talk about this in a little bit when we get to LLCs, but a true S corporation, again, is an independent legal entity. It's an incorporation, just like the C corporation. It preserves that liability, that personal liability to the corporation, independence from the individual. And then some of the cons, again, complex to set up and maintain. It's an incorporated business, so that you got to have the minutes, you got to have the meetings, you got to go through all those corporate structure hoops. One of the items I didn't mention with the C corp, I guess, was the flexibility of there being 1,000 owners. If you own Apple stock, you are an owner in a C corporation. Apple cannot be an S corporation. And because of the size limits, you're limited to 100 people to an S corporation. So if you had 101 owners, you would have to make that transition to a C corporation. So a lot of businesses, kind of large or small, and in Montana's world here, almost all are S corporations. And if they're not, they're likely C corporations. But most can fall into that hoop. And so that's, again, one of the reasons when they made the S corporation rules, the idea was small business, make it a little easier to get money in and out of someone's small business. And then the limits on the number of classes of stock. One of the big reasons, that the big corporate structures, the C corps of the world, are able to get capitals because they can offer different classes of stock, and there's benefits and certain little ways to get capital infusion there. You don't have that sort of flexibility, and you have the limitation of there just being one class of stock for the S corporation. Not a big deal for a lot of companies, but if you're looking at maybe trying to have different levels of stock, maybe you're trying to incentivize certain employees to come up through the ranks, and you maybe don't want them to have ownership of the company, but you want them to have some different level of ownership, maybe not managerial ownership, then you would maybe look at different levels of stock. You can't do that with S corporations, but you can with C corporations. And so that's oftentimes one of the reasons, as I talk through this, people will be a C corporation maybe because of those different levels of stock, classes of stock. That might be just something that's just its inherent value, depending on the industry that they want to offer to their employees. And that could maybe outweigh, maybe they'll pay a little extra tax in doing so, but the benefit of having that ownership within could outweigh the tax consequence. And then reasonable compensation rules. I think I talk about this daily in my job. And I actually had that noted on the C corporation slide. Ironically, for reasonable compensation rules on the C corporation side, people may actually look to overcompensate themselves on the C corporate level. On the S corporation level, we tend to have to watch out for those that want to underpay themselves. So very briefly with the C corporation rules, remember I said there's two ways to get money out of the C corporation: wages or dividends. Those dividends will ultimately be taxable. Wages, of course, are taxable on your personal tax return, right? So there's that level of double taxation there. But the dividends also are taxable in a C corporation setting, whereas they're not necessarily double taxed in the S corporation setting. So what would you do? You would just raise, on the C corporate level, you would raise your wages to get away with the double taxation of drawing money out not through wages. So instead of paying myself $50,000 and the bottom line showing $60,000, maybe I'll just pay myself $110,000, get all the money out, and not pay the corporate tax rate, and I'll pay my individual tax rate. And that's just an example. But is $110,000 egregious? Should I really have been paying myself $110,000? Am I going to do that next year? Did I do that the year before? That'd be the question. S corporation world, if I don't run something through wages, I'm simply paying my individual income tax rate on the bottom line. And so then I can take that money out whenever I want, and it's not a taxable dividend. And so, and when you remember, when you run stuff through wages, there's the idea of not only is the idea of self-employment tax. And so the gamesmanship, so to speak, would be is, well, if I can push my wages down, I'm going to pay income tax, but if I push my wages down, I won't have to pay as much as self-employment tax. And obviously the IRS, all the state agencies, they're on board and understand what is going on here. And so reasonable compensation rules are incredibly important to understand. We're going to talk about those here shortly. So hang on to that thought, because we will be talking about those. Not paying too much, not paying too little. So the final entity type that we need to talk about is the LLC. And the LLC I call is called the hybrid model. So everything we've talked about, sole proprietorship, partnership, C corporation, S corporation, this is where, make this note, an LLC can be any one of those. So if I wanted to be a sole proprietorship, well, I should say you can act like any one of those as an LLC. So if I wanted to have that Kool-Aid stand and be a sole proprietorship, I could do that without doing anything. Or I could set up an LLC and be taxed the exact same way and kind of act like a sole proprietorship. If I had a business partner that wanted to come in with me and we wanted to start a partnership, we could do an LLC and be taxed like a partnership. Same with the C corporation, same with an S corporation. So an LLC is really it's a state structure. So you have to register with each of the states. I had to come up with a con. And so the con is that you have to register with your state that your LLC is essentially established in. But other than that, it takes on a lot of the pros of each of the other categories. So simplicity and structure. Similar to the sole proprietorship, you don't have to do much. You don't necessarily need formal documents to start an LLC. You get the liability benefits that a corporation. It's not identical. Again, time out. Let's get the attorney in the room to really talk about this. But there's liability protection inherent from having an LLC, similar to what you could get in a corporate structure. Not identical, but similar. And so it's incredible how many, so the LLC is very powerful. And so when the question comes, what is the best? Well, unfortunately, the answer is it depends. And I'm really sorry for you're not going to get the answer here. But the answer truly is it depends. But I can tell you the LLC enters the conversation every time. Every time. So here are some examples where we can talk about that, but the LLC really truly does give you the platform. Here's your note. This is the note. This is what you need to write down. The LLC, establishing the LLC, gives you the platform to springboard and give you the ultimate flexibility to kind of do whatever you want to do today and into the future. So I almost put LLC was the best choice, but it truly depends, because you don't necessarily need to be an LLC. In fact, you may want to be an LLP if you're going to be a partnership, and there's a weird rule around that. That's what you need to be. Maybe you have a non-resident partner, right? I mean, to the U.S. Maybe there's someone from the UK that wants to be a partner, right? They might need to be in an LLP versus an LLC. So again, there's no answer here, but the LLC seems to be what we always kind of come back to. And so here's some examples. Let's say you're selling coffee mugs on Etsy that you handmade in your garage, right? So the first thing I can tell you right now is, I kind of go away from the C corporation on that one, right? This is small, this is tiny. I think sole proprietorship. And then one step further is, I think LLC. Now again, I'm in Montana. And so I think it'd be a different answer if I was in, not to pick on California, but to pick on California. If I was in California, I might not set up an LLC. Why? Well, they're expensive. Bottom line to me, out of the gate, it's expensive. I mean, you have minimum tax requirements as an LLC business in the state of California that far outweigh the cost of like a state like Montana. Every state's different, so make sure you consult with the right person to figure out what state you need to be set up in. But my answer might be different if we were all in California talking about a California person selling coffee mugs on Etsy that they made in their garage. An LLC might not be necessary at that point. But from Montana's perspective, it costs about $100 to set up an LLC, $20 annually to maintain that LLC. So in my mind, pretty cheap. Is there exposure in this business? Probably not. But at the same time, do you want that LLC protection? Do you want a business bank account? Is there something else going on in your world that you just want that LLC status? I would entertain the idea. If you didn't, you'd be a sole proprietorship in this first example. And if not, and you want to be an LLC, you could act like a sole proprietorship, but be an LLC. Again, you register with the state, and you essentially just start operating as that LLC name, and you're off and running. There's no special tax return. It's still a sole proprietorship. Is in the LLC world is called a disregarded entity. So it'd be still taxed on a Schedule C on your personal tax return. No change in tax or anything. Same deductions, same everything. So that first one, I think it's kind of a coin flip between an LLC and a sole proprietorship. Second one, so now a little bigger, right? I've got 15 to 20 employees. I've got maybe some stands or some brick and mortar places across Western Montana where I'm doing my roasting. I've got some coffee houses, stuff like that. Okay, my first instinct is, okay, are there multiple people? Is this a partnership? I'm not thinking C corporation yet because it doesn't sound big enough. But maybe, do I want to incentivize some of my employees to have different classes of stocks? So I need that C corporation. Do I be an S corporation? Is this a husband and wife, or is this four siblings? What is this? And so I just mentioned sole proprietorship, partnership, S corp, C corp. Well, now what if we were that LLC again? So we set up an LLC, and what do we want to do? We want to be taxed like a partnership. Okay, we can do that. And so you could set up an LLC, have the legal liability protection, and be treated as a partnership, and there's different rules that surround that. Do we want to be an S corporation? So an LLC can be an S corporation by electing to be an S corporation. And so that could be a great idea here. Maybe this is a solo person. It'd be a one-person S corporation. So rather than a sole proprietorship, it might make more sense to be an S corporation, but I don't necessarily want the hassle of an S corporation, a strict S corporation, but I can be an LLC that looks like an S corporation. Maybe I'll do that. And so that's a very common fact pattern. LLC, make an S corp election, and now you got all the best of both worlds. You're maybe cutting down on self-employment tax. You are acting like an S corporation with legal liability protection, but you don't have all the hassle of the corporate structure rules, meetings, minutes, all that fun stuff. So that's a great option. And then the third here, coffee shops on every corner across the country, 10,000 plus employees. You've gone public. Okay, what does that scream? That screams C corporation, right? If you're going public, you're having people from all across the world basically invest into you, be a part of your business. You couldn't do that if you were going to do that with more than 100 people. So all of a sudden, in that case, you're more likely than not going to be a C corporation, and you're to the point where obviously a sole proprietorship is not in play. Partnership, kind of goofy with that many people in a partnership setting, doesn't work. S corporation, too many people. LLC, so again, you could be an LLC that gets taxed as a C corporation, but this is where an LLC, remember, you have to register in every single state, and so you might not want to do that, and that gets way beyond the scope of this presentation of should I be an LLC taxed as a C corporation, or should I just be a C corporation? My point was, as soon as I said public company, in our head, we're right away thinking C corporations, hence why we don't set up a lot of those in Montana, but just important to kind of note the difference between a C and an S corp specifically. So it depends on what the best choice is, but I've said LLC quite a bit, so I think you kind of know what I'm trying to say without saying it, because it depends, but LLC is just one of those platforms because of how easy it is to maintain in the state of Montana, because of how cheap it is to start up in the state of Montana. We oftentimes see LLCs set up, and then You start an LLC year one, okay, you get big, you want to go to an S corporation. You start an LLC, and you now want to make the election to be a partnership for some reason. And those are the things that we talk through to make sure we're doing the right thing. Okay, the buzzword, and what we're going to talk about now for the next few minutes is the idea of should I be an S corporation? This is the #1 question I get on a daily basis, through email, through phone calls, through side conversations, standing in line somewhere, and we start talking taxes. Inevitably, someone's out there in a business setting, they're not an S corporation, their friend told them, you should be an S corporation. What are you doing not being an S corporation? And so then they ask, well, what do you mean? They say, well, talk to somebody, you got to know. So then Jake gets the question, Jake, should I be an S corporation? And so this is actually the reason I even put this presentation together, because I just found that it was such a common question. And this is, I'm sure a lot of you maybe watching this have endured my painstaking answer before, and my horrific drawings on my paper sketch pad, but bear with me here, because I think there's a lot of other people that it's important to hear this, and it's great knowledge to have. So, should I be an S corporation? These are the 3 questions I almost always ask. And so I ask right away, well, how are you currently structured? And so it's either someone that's probably in business, maybe they're an LLC, maybe they're a sole proprietor, maybe they haven't even started their business yet, which I love. They're proactively asking me, Jake, what should I be out of the gate? And so that's what I find out right away. In general, if we're going to make some assumptions here, let's assume maybe for a second that this is a new business, because I think it could apply even if you've already started a business. And then the other question I ask is, do you or will you have employees? And that's an important one. I'll make mention to that why in a moment. But that's a good question to ask, because that's giving me kind of scope on the size of your business. That's giving me an idea of what sort of costs that you're going to have just inherently operating your business. And then I also ask, what is your net taxable income going to be? Super easy for those that maybe been in business for 1, 2, 3 years to have an idea of what the upcoming year will be like. And then also for those that have not started a business, it gets them kind of start thinking about, how much do you intend to make, or what do you think your income will be? Because the answer will definitely change what I would advise upon based on this answer. So I wanted to get all those out on the table, but basically, to kind of go back through each one of those, how are you currently structured? If we assume that someone, let's just say, is not, let's say is a startup, I then, of course, then start asking these other questions, but I normally would say, okay, if you're going to start up a business, and most often, and obviously questions 2 and 3 would maybe change this answer, but most often it's a true startup. We're not hitting the ground with 50 employees and elaborate stuff. It really is kind of a core, just true startup business. And so what I normally would say is set up an LLC. So and look like you're a sole proprietorship. So that's disregarded entity. So set up an LLC, because what that does, what was my underlining message today? The LLC lets you springboard into that next step at any kind of moment in time. And so very common, one of the most common fact patterns is you're an LLC, you're a disregarded entity, meaning you're like a sole proprietorship, but you report your activity on your personal return. And then one day you ultimately make that decision, okay, and usually it's to an S corporation. That tends to be the progression. Start up a business, you're an LLC, and then you become taxed like an S corporation. It's very common in a operational business activity. That's very common. Again, it might be a partnership direction that you go. It might be a C corporation that you go. But again, what are you starting with? You're starting with that LLC. Very, very common. And then the question is, or what kind of comes into the question is, okay, now that we've decided maybe I'm an LLC, what was the overall question was, should I be an S corporation? And so what I say is, first become an LLC, and then when do you springboard, because the LLC allows for that, when do you make that S election depends upon, in my mind, the next two questions. So how many employees will you or do you have? Because if this is a startup business, then maybe they already have some employees. Or not startup, but an existing business, maybe they already have employees. So find out how many employees there are going to be, and how much your next tax, what's your overall income going to be. So let's go back to our assumption of it's a startup business, and they say no employees, Jake, no employees. Yeah, it's just going to be me. Maybe it's going to be my spouse as well, one or two people. Let's just assume me for now. Okay, great. So if you become an LLC and you want to be treated like a sole proprietorship, disregarded entity, no special tax return, you report on your personal taxes, you report the activity on your personal income tax return. So you don't pay anybody. You don't need to necessarily have an employee. So while you are the only person working the business, in that setting, you don't need to have an employee. You don't need to pay yourself. If you go to the S corporation structure, an S corporation structure must have employees. So you, the owner in that example. So the question is, if I make the leap to the S corporation, not really a question, the understanding is you need to pay yourself. And the act of paying yourself as an employee is not just a quick check and you're done. It is a complex process. You are having to register with all the payroll entities out there. So with the IRS, with the state, with work comp, with the unemployment insurance division, you're having to register all of those accounts, file all of those reports quarterly, annually, monthly, whether you pay anything or not. I mean, you're starting to take on a lot of responsibility if you're going to make that jump to the S corporation level. And so that's why the question is, how many employees do you have? If you already have employees, you're already doing that. And so the jump might not be as big of a hurdle, because what I'm very cognizant of when I make the recommendation to be an S corporation is, what's the cost going to be for you? If it's going to cost all this money and not really save you anything, there's no benefit, why do it? And so it's important to understand the concept of paying employees. You must pay employees if you're going to be an S corporation, whether it's you and a spouse, and 5 other people, you and 20 other people. There's going to be payroll. There's going to be a cost. What's the cost to administer and stay compliant with payroll? That's what I call a nut you got to crack. What are you going to do? What do you got to do to be an S corporation? There's a cost to it. One of those biggest costs is payroll. And then the other is with what is your net taxable income? I asked that because this is kind of rolling all the way back to one of the first slides when you're talking about a sole proprietorship. And so when you're a sole proprietorship, what did I say? All of your income is going to be, all of your net income is going to be subjected to self-employment tax. When you're an S corporation, you're not going to really see this in the rule book from the IRS, but they basically, with an S corporation, you get to choose how much taxable income you want subjected to self-employment tax. And what did we talk about a couple slides ago about the idea of choosing or determining how much you pay yourself? Reasonable compensation. And so that is then the conversation, and I've got a slide here coming up that's going to help quantify this, but that then really starts molding the conversation of, when do you go and become an S corporation? Because there's going to be a cost to be an S corporation. Those costs, the two nuts you got to crack: payroll compliance, and then the one that I haven't really talked about, but I'll say right now, is the idea that you have a separate entity tax return you have to file. Those are the two biggest items that you have to weigh. What's the cost of running payroll and filing a corporate tax return versus any potential tax savings? And the note on this slide, we're about to change the slide finally, because we've been on this too long, is S corporations are often set up for self-employment tax savings. And what I get all too often is, Jake, I've heard that you save income tax by going to an S corporation structure, and that's not always necessarily true, but the hidden kind of gem of the S corporation is the ability to possibly cut down on unnecessary self-employment tax. I'm not anti-self-employment tax, but I am letting my clients determine how much they want to pay in self-employment tax and giving them that decision tree of, you could pay a little less tax if you wanted, and here's how, here's why. And so that's really one of the biggest benefits that people need to understand is why you would set up an S corporation. If your goal is to cut down on tax, it's the self-employment tax you potentially could save on, and the decision to go to that setting because of that you must save as much tax as you would be in compliance costs, in my opinion. Otherwise, why make the switch? There could be other reasons, but if that's the reason, then you gotta do the math on that. So we're going to find out what that break even is here shortly, but I wanted to touch quickly on the compensation rules. We talked about it when we were on the C Corp and S Corp slides, and the fact that with the C Corporation, I'm kind of jumping to the bottom of this slide. The C Corporation was, reasonable compensation, but not too high for the double taxation factor. The S Corporation, not too low for the self-employment tax, skipping out on self-employment tax or paying too little in self-employment tax. So that's the idea behind the owner compensation rules. I make a note on the top here, just that in regards to owner compensation, understand there's no wages or what gets reported on a Form W-2 wages. There's none of that necessary in a sole proprietorship setting. In the partnership setting, there's different rules surrounding the partnership setting. Those are called guaranteed payments instead of wages. And then the LLC that has not elected to be taxed as a corporation. In other words, the LLC that's getting taxed as a sole proprietor or a partnership. So on the top there, that's basically saying there's really not owner compensation rules for those entity structures, sole proprietorships, partnerships, disregarded entities. But there is the rule for an S corporation and a C corporation, including those LLCs that are acting like S corporations and C corporations. So that's just the takeaway here is understanding those rules, but the owner compensation rules come into play when we're dealing with S corporations and C corporations. And I've kind of alluded to it already, what those rules are. There's I don't have a note on my slides, and here's kind of the breakdown of that. You're going to notice that there's no quantification of that. How great would it be if I could open a book and look and say, okay, this is what they do, there's the number, and great, we're moving on. There is no bright line like that. Now, there are some materials that we can look at to see what the average wage paid is to a mechanic, a 5-year mechanic, let's say. We could maybe attempt to quantify, but truly there is no bright line. The IRS, in fact, tells us there really is no bright line, but there are things that you can look at. And so 3 of those items that you look at are the sources that are generating the business's gross receipts. And so it's the services of the shareholder. That shareholder is the one that's in question of this whole reasonable compensation topic. And then also services of the non-shareholder employees, and then capital equipment. Bottom line here is what's making the dollar for the business? Am I a consultant that's just using my brain to generate, that's my words and this and that? It's hard to say that he's utilizing other things. Any dollar he or she makes should probably be self-employment tax ran through wages. But if I'm leveraging $1 million technology, computer, something software, if I'm leveraging 40 employees, now all of a sudden, all of your income, all of your net bottom line income might not be because of you, the owner that's having to compensate themselves. It might be other aspects that generate that income. So there's so many different things out there that could drive the owner compensation amount. And so bottom line is, what would I pay someone to do my job? That's really the question. But even then, it can depend, because how much income did you make that year? Was it a down year? There's so many different factors. And then a final comment, a kind of a tax planning comment. I had this conversation today was, do we need to increase your wage to allow for more IRA contributions? Because remember, in order to do IRA contributions, you have to have earned income. If I don't pay myself $1 in wages, saving on self-employment tax, but I want to do a Roth IRA, well, I can't, subject to other limitations. But in general, that's a statement that I can kind of share with you, in that just be careful. I mean, if you're trying to jam a bunch of money into your SEP, you might need that owner compensation in order to do that. And so I guess I wonder if I blew by a slide. I'm sorry. I did. I blew by a slide. So we're going to go back to this. This is what helps quantify. Should I be an S corporation? Sorry, I really held everyone's suspense here, and then we're going to move on really quickly to one final topic. But this is just an example of when I've got someone that's a sole proprietor, and they're looking to be, Jake, should I be an S corporation? And so it's the same fact pattern, except so gross income's the same, expenses are the same, and then in the sole proprietorship, remember, there is no wages to be paid, so they're going to pay tax on that $70,000. In an S corporation, you decide how much of that $70,000 you want to run through wages. My example says $45,000. The rest, so $70,000 less 45, so 25, runs through bottom line, and then that gets reported on a K1. So same fact pattern. When you look at both of their personal tax returns, they both have taxable income of $70,000. Sole proprietor, it's a Schedule C, $70,000. S corporation, you have a W-2 for $45,000 and a K1 of $25,000. The 1040 is the same. The page one of the 1040, their gross incomes, their net income, their adjusted gross income is the same. The income tax is the same, right? Because there is no change really in what's taxed at the federal or state level for income tax. I assume the 20% tax right here, just so for the math junkies out there doing the math. And then the self-employment tax, that's what changes. In a sole proprietorship setting, the entire $70,000 is subjected to self-employment tax. I just rounded numbers here, 15% times $70,000. On the S corporation setting, you dictated how much you wanted to pay in self-employment tax. You decided to pay yourself $45,000 on a wage, that's subjected to the self-employment tax. You're the owner and the employee in that case, so you are on the hook for the entire self-employment tax. Again, I just used 15%, rounded numbers. And so all of a sudden, you're paying less than self-employment tax. So you can see the savings, $3,000 plus in savings. And so, and that's roughly the 15% on the net income in the S corporation world that you decided not to run through wages. 15% on $25,000 is your overall savings. Now, don't just say, oh, great, I saved tax. Remember, got to crack two nuts. Payroll compliance, what's the cost for you to do that, as well as to hire me or some other accountant or do it yourself, take the time to do it, to file a corporate tax return. And that is how you determine, should I be an S corporation? Figure out what your savings could be. Could it be this high, or is your fact pattern different? We have to talk through that. Do you need to do payroll? You're already doing payroll. What's your net income look like? If this net income was way low, it might not be worth it. Why go through all of those headaches to file extra tax returns, pay me to do your payroll, and all for what? That's the underlying answer behind should I be an S corporation? And then I do see one question in the queue. I'm going to get to that, but I'm going to finalize the talk here today just quickly about the QBI. And really, I don't want to go into the weeds on this. I could go on for an hour on this one slide. Believe it or not, all of you that know me, you're probably like, no, Jake, you could do 2 hours. You're just a chatty Cathy. But very quickly, the QBI deduction, I think the main takeaway here is it doesn't apply to C Corps. And so really, when that C corporation flat rate dropped to 21%, this was a couple years ago under the TCJA, the corporate rate dropped to 21%, and the kicker, kind of the equalizer for everyone else, kind of held out like, why didn't we get this huge tax rate cut? We sort of did at the individual level, but remember, S corporations, LLCs don't necessarily pay a corporate rate. And so this QBI deduction was kind of thrown in there to help equalize and help businesses save on tax. And so it's just important. It's good to know, one, the QBI deduction's out there for all non-C corporations. So if you're anything but a C corporation, you need to be having this conversation with your tax person. And two, to loop in the reasonable compensation discussion, there's limitations to this deduction if you're not paying yourself enough. So there's now like this other tax break you could be missing out on if you're trying to save self-employment tax on not paying yourself enough. So just something to be mindful of. And that's really what I wanted to talk about in the QBI world. That's a lot of information that we kind of hit there. I've got a question, and I can, if anyone needs me to back up to a slide, we got several minutes here. I really wanted to open up to Q&A, so please type your questions in the Q&A box. I've got one loaded up right now that I'll answer here. But if maybe you want me to back up to a slide just to see it while we're on, I'm sure anyone would benefit from that. And so please type in your questions in the Q&A, and I'll start picking those off. One of the questions that came in is, and it's a great question, are there any rules of thumb about the relationship between wages to the business owner versus profits? And so a lot of you who have probably talked with me, if you do a quick Google search, a very, very, very common metric, the rule of thumb, there's a 60-40 rule out there. Basically what that is, in a perfect world, what that would look like is I made $100,000 and I'm an S corporation and it's just me, I'm a consultant. And so I made net $100,000, $150,000 of income, $50,000 of expenses. And now I'm tasked with deciding what is a reasonable compensation for me, right? If I'm not an S corporation, I am paying tax, not only tax on that net $100,000, but I'm also paying self-employment tax on that $100,000. And so the question is, if I'm an S corporation, what is the rule of thumb to decide how much I call self-employment income of that 100,000? So i.e., how much are you going to wage yourself out? How much are you going to pay yourself versus what you let flow through and essentially evade self-employment tax? That's the big conversation we've had on this webinar. And so the rule of thumb, I don't necessarily write it down because it's so, you got to be careful. But the rule of thumb out there is the 60-40 rule. The 60-40 rule in that example would be is that you would run $60,000 through wages and $40,000 you would let flow through to the bottom line onto the K1. Again, $100,000 is still going to be taxable, federal and state income tax. But instead of all being subjected to self-employment tax, only $60,000 will be subjected to self-employment tax. The other 40, you're going to essentially avoid and not pay self-employment tax on that 40,000, that's $6,000 of self-employment tax. That's significant, and that's the discussion. That's what we're tasked with when we in this example is what should I pay myself? It's kind of a shot in the dark. And really, what another way to put that, I'm not saying this is how the person has asked me, is, Jake, what can I get away with? If I'm trying to pay as little amount of tax as possible, what am I trying to get away with? That's oftentimes the underlying question. And so is there something we can lean on that says, well, I did it this way, so I should be okay? And I'm not saying that person asked it that way, but that's one way I get it asked to me. And so the other way this could have been is, well, how much can I pay maybe? And so you could, of course, pay the whole amount. That's a decision, because maybe what you wanted to do was you wanted to max your SEP IRA. And so to get the max amount of that, you would pay yourself $100,000. Now you could do 25% of your $100,000 into SEP, and you're getting this great tax deduction. And oftentimes, the tax deduction will outweigh the savings in the self-employment tax. So hire a good accountant to be able to do that math for you, because that's a huge tax savings sometimes by paying yourself more. It sounds counterintuitive, but essentially what you're doing is you're paying 15% tax to save 25%. I do that all day long for sure. Someone made a comment. They said current structure C Corp. So I don't know if that's just a statement or a question. So maybe if you want to type in and elaborate on that. Another question came in. It sounds like a big difference between the S Corp and the C Corp is how much you're planning to pull out. Is there? Oh, is there a kind of a crossover? Is there a crossover point where one is better than the other based on income, profits, and planned distributions? Yes, I would say yes. What comes to mind for me would be if, because right, the C corporation flat tax at 21%, that sounds low. So maybe, I guess I would quantify, I would want to make sure that we're not misunderstanding that the corporate tax rate of 21% sounds pretty low. Yeah, that one might take a little bit more explanation or understanding. So I think I get the concept behind that question. Is you're trying to figure out, is there a balance? There's a big difference based on how much you pull out. Is there a crossover? Is there a balance? I guess I wanted to say yes, but really, let's take an example where you don't pull any money out. If you're not pulling any money out, I would hope to shout then that you're not paying a ton of corporate tax. Because if you are, then there's money that you're paying tax on that's staying inside the corporation. It's stuck there. And so if you fast forward to the next year and figure out a way to get that money out through wages, so you deplete the cash, the issue though is you've already paid tax on it. So I guess the way I would attempt to start analyzing that is give me what you've got. So is your net taxable income 100,000? What you must understand is that 100,000 you're going to pay 21% tax on. That's the federal rate. There's another state corporate rates as well potentially out there, but the IRS tax rate would be 21%, and so you would pay the tax on that dollar. And now, no matter what you do with that, whether you wage it out the next year, you dividend it out a different year, you've technically paid tax on it. Even if you spend it the next year, you've paid the tax on it. And so I would maybe I'm backtracking on, there is a crossover point. I would say in that example, why not be an S corporation where you wouldn't have to necessarily pay that corporate tax rate? Okay, so I guess as I'm talking through it, if your flow-through rate is higher than 21% and you weren't wanting to pull that money out, that would be the big kicker. Yes, there could be an advantage there, but I'm not even close to even guessing on what that would be. It would totally depend. And maybe the question, I'm totally going deep into this one, but maybe is, are you drawing out thousands of dollars or hundreds of $1,000s every year? And I'd have to sit down and do the math on that, because there's still these odd limitations in the C corporation world that I would be hesitant to think that there would be this huge benefit. The number one benefit, obviously, is the fact that you could have more than 100 people. And so if that's not the case, then there's probably some other underlying issue to keeping it as a C corporation. And oftentimes, in the right setting, you figure out a way to keep that bottom net line as low as possible through other means. And usually it ends up being through compensation. And so if it was important to have that C Corp structure, you could probably make it work. But be kind of interested in talking to someone to that person who asked that to elaborate more. Comment, as clients get older, avoiding SC tax means their Social Security income will be less at retirement. Exactly. So should we advise them on paying as little SC tax as possible? That is fantastic. And that is, I will tell someone, here's how you can save tax. And then the next thing they must understand, and I tell them, is realize what you're doing. You're saving 15% tax, but you're saving self-employment tax, which there's a potential consequence to that. And so what are we doing? Are we paying 90,000 instead of 110? Are we paying 20,000 instead of 50? So I'd want to know how much less are we attempting to do, and then the why behind it. Is this a one-time deal? Are you planning to do this for the next 20 years? Because there is, as this comment is made, you are affecting income later on. To do that math is near impossible, but to drastically try to just save Social Security tax for the purpose of purely just paying less in Social Security tax, you potentially are decimating future income if this is going to be a perennial thing you decide to do. And so it's a fantastic comment to understand what I've said today as kind of a mechanism of S corporation benefits, but be very cautious that there's other issues. For example, I will tell someone to pay more because you'll be able to put more into your SEP. And so all of a sudden light bulb goes off, oh, of course, I'll pay that to save this. And so definitely take into account the Social Security aspect of that as well. It's a great comment. Question, what is your dollar amount cutoff for net income when it becomes beneficial to switch to an S Corp? My personal one was actually the example I gave you, so $70,000. I usually range between $50,000 and $75,000. And so the answer to that basically is, at what net income level can we make the switch to then say, well, I'm only going to pay myself $50,000 instead of being taxed by self-employment by $80,000. That's just an example. Or I'll pay 50 instead of 70. And so you start getting your break even of savings and self-employment tax versus the two nuts you got to crack, payroll compliance and cost to file a tax return. So that was my break even. That's a good question. For any level of profitability, is one better than the other based on how much you're pulling out? Okay, so this might be the person. So it sounded like that C corporation is 20 plus. And I should probably say that for those, I've hit my noon to 1 time limit. Please stay on as long as you want. I'm going to finish up answering these questions. I've got about 3 more to hit. But I can't thank those enough for tuning in, spending your lunch hour, hanging out, learning about all the great, amazing things about S Corps and entity structures. Hopefully you got something. If you need anything, my email is on the screen. Please email me. Please call me. Always happy to help. Clients, non-clients, JCCS is here to for sure help you out. So thank you again. Stay on though. I'll answer the remainder of these questions. The comment that I was rambling on about earlier about C Corp versus S Corp, they helped me quantify a little bit. 20 plus employees, C corporate structure, $150,000 to $200,000 net profit each year. No need for different stock types or plans to go public. S Corp looks to be a much better option. What does the transition look like to change to S Corp? Oh, okay. Yeah, I would say in that setting, C corporation, there are some handcuffs there. So one of the biggest one thing that if we dove deeper on this would be so the first question I would actually find out is I would want to see what is the history of this C corporation. Some of these tend to have net operating losses, and a lot of times if you shut down the C corporation, you're going to lose those. You're going to lose those benefits of the net operating losses. Those are with the corporation. They stay there, and you can't take them with you if you go to the S corporation world. And then the transition is, I've done it, and I'd have to look over those rules again. But there are certain rules whether you're going from S to C or C to S, and so we'd have to be mindful of. Let's say you've got $100,000 of equity built up inside the C corporation that you have paid the flat tax on, the corporate rate on. Well, you understand that, okay, if we want to get that money out, it's going to be through compensation or through dividends, a taxable dividend. And so obviously there's rules in place that don't allow you to switch to an S corporation and then all of a sudden say, oh, okay, we can let that come out tax-free. I believe there's something like a 5-year rule, and you've got to pick away at that base and somehow get it out. And I have to review the rule. That's a good question. I haven't done that in a while. to confirm that, but there are ways. It's just that you have to do it over time, and you can't just strip those profits out and not pay tax. And so definitely sounds like you need to definitely have that conversation to figure out what the cost would be to peel the Band-Aid and either switch right over to S Corporation and get that money out, or figure out how you can maybe strategically get that money out over time. For something, there's a 5-year rule out there that sticks in my head. Sorry, I'm not prepared to answer that question, but definitely follow up with me if we need to explore that more, because I would say, yes, that's the biggest hurdle. If you don't need the multiple types of stock and you're not over 100 people, we're not setting up C Corps, it just seems like, anymore for that. Even with a 21% flat tax, there's other things that inhibit. There's just other ways to actually still pay less tax. If you think like your individual tax rate is 32% and you're hearing a 21% corporate rate, it's not as simple as doing that comparison. 21 sounds flashy, but it's not as good as you might think. So we got to run through that calculation for sure. Question is, my wife and I are the 2 members of a Montana LLC holding rental real estate. How do we file our taxes? Okay, so a lot of what I've been talking about today has been about operations, business operations, and not so much about maybe something else, maybe a little less business operations, but more of like a rental holding company. And so that gives a whole nother idea of maybe why not everybody is an S corporation, because kind of a rule of thumb is you don't often set up an S corporation, an LLC that we tax as an S corporation. That's great for my business venture, but if I'm going to hold real estate, you don't do that. And that's just kind of the underlying rules of real estate versus corporations. And so the advice there would likely be to set up an LLC and then put it into and tax it as a partnership. And so the question here is, there's 2 people, it's a Montana LLC, and they're wondering how to file their taxes. When you set up an LLC, the biggest thing would be to understand is, how are you electing to file with the IRS? And that goes back to, okay, you can be an LLC, and then you got your choice. And so if you're doing more than 2 people, and in the real estate world, I'm not going to be a corporation, the default is then that you're a partnership. And so the question is, do I file on a Schedule E? And I think, or the other question is, do I file a partnership return? That is, I think, a very long-standing headbutt between CPA versus a different CPA on what you should do. Because one would argue, don't mess with the partnership rules, don't mess with having to file an extra partnership tax return, because at the end of the day, that activity is all going to flow to the personal tax return because it's a husband and wife. And because of the nature of the business, the fact that it's not a business activity, so it's rental activity, didn't have this conversation today, but rental activity is not really self-employment income, usually, 99% of the time. So really, the answer is going to be the same. It's really, do you have the headache of a Schedule E, where even though it's a husband and wife, there's more than 2 people in this LLC, which really by definition is a partnership? Why go through the headaches of a partnership tax return when you're going to end up in the exact same situation? And I don't necessarily think I can point to anything specifically other than, how many people are there? You're an LLC. How are you holding yourself out to the IRS? And so what I normally see is an LLC gets set up if it's more than 2 people, if the default is a partnership, and so we're filing partnership tax returns. So I really think it's just all about the setup. Even in a husband and wife setting, I take the position as more than 1 person, it's a partnership, you're doing a partnership tax return. And so to get around all of that, in my opinion, is to figure out a way to not have both names either on title or in the LLC, and either have one person on title, the other a beneficiary, or in some way do that, because there's a lot of benefits, husband, wife, or spousal transfer that I would do to attempt to get out of the partnership tax return filing, if I wanted to. If not, I'm setting up an LLC. If it's 2 people, it's a partnership, and this is all for real estate activity. Again, reminder, I'm setting up the partnership and filing a partnership tax return. So not necessarily Schedule E, page 1, but page 2. Okay, I think that was the last question. Running through, making sure I didn't miss any. If there are other questions, please email me, please call me. I hope everyone here today picked up some sort of a juicy nugget that'll help them in the future. And thanks again for joining us. And if you have any questions, reach out, and be sure to look for this and other webinars on our website. And I hope everyone has a wonderful day. Thanks a lot.